Hello, investors. Today, we're diving into the world of dividend stocks, a fascinating corner of the market that holds the promise of both income and growth. Dividend stocks are like the rock stars of investing, offering regular payouts to shareholders while potentially appreciating in value over time. In this video, we'll explore top 5 dividend stocks to buy for the start of 2024, why they're a staple for many investors, and how you can navigate this terrain to build a portfolio that pays you back. So, grab your notepads, because we're about to uncover the secrets of dividend stocks and how they can supercharge your investment strategy. Let's get started. Number 1. Verizon Communications Inc. It looks like the worst is finally over for the telecom industry. Verizon has rebounded from a low of $30 to roughly $38 today amid a brightening future for the telecommunications firm. Verizon was caught in a huge spending cycle as it invested heavily in 5G networks. These investments have been slower to pay off than expected. Throw in rising interest rates, and investors have fretted about the firm's large debt load. Now, though the recent dip in Treasury yields should start to alleviate those fears, and competition appears to be stabilizing, Verizon's management has indicated that it has passed the peak of this spending cycle and that cash flows will be more robust heading into 2024. Even after the recent rebound, Verizon is still a deep value. Shares go for 8 times forward earnings and offer a 7.2 dividend yield. Number 2. Enbridge Inc. Enbridge Inc. emerges as a powerhouse in North America's midstream energy sector, boasting an extensive network of pipelines and energy logistics assets across Canada, the United States, and Mexico. The value proposition lies in the long life and inflation-protected cash flows generated by pipelines, which are increasingly scarce due to political and environmental obstacles hindering new constructions. Despite investor concerns over Enbridge's sizable debt load and the impact of higher interest rates, the company's stable utility-like nature positions it to thrive. The utility model, coupled with the strategic importance of existing operational pipelines, mitigates risk and underscores Enbridge's potential for continued success. Notably, the stock's current 7.60 dividend yield adds an attractive income component for investors seeking reliable returns. Number 3. British American Tobacco (BTI). British American Tobacco stands as a global tobacco industry leader with a historical legacy as one of the largest cigarette vendors worldwide. In response to evolving consumer preferences and health considerations, the company has strategically diversified its portfolio by making substantial investments in emerging technologies such as vaping, heated-not-burn products, and alternative nicotine delivery platforms. However, BTI recently faced a setback as its stock experienced a significant drop to multi-year lows, attributed to a substantial write-down of its legacy cigarette business. Despite the short-term challenges, forward-looking investors are encouraged to shift their focus from the past, as British American Tobacco is actively steering its future towards reduced-risk products. Notably, sales of these products are experiencing robust growth, surpassing expectations and positioning the segment to achieve profitability earlier than initially anticipated by management. Currently trading at 6 times forward earnings, British American Tobacco stock presents an appealing entry point, especially considering the substantial 9.5 dividend yield. The market's undervaluation of the company is highlighted as the stock's price seems disproportionately low, especially when considering the positive trajectory expected in terms of revenue and earnings growth in 2024. This combination of a forward-thinking approach to reduced-risk products and the potential for significant returns makes British American Tobacco an intriguing investment opportunity for those with an eye on the future of the tobacco industry. Number 4. United Microelectronics Corp. (UMC). UMC is the world's third-largest semiconductor foundry, trailing only Taiwan Semiconductor Manufacturing Company Limited and GlobalFoundries Inc. Semiconductor companies that don't own their own foundries outsource their chip production to companies like TSM or United Microelectronics. Given the rise of AI applications, the Internet of Things, connected cars, and other such computing use cases, the overall demand for semiconductors is expected to boom throughout the 2020s. The foundry operators, like UMC, will naturally benefit as the total addressable market expands. United Microelectronics shares have been held down by uneven operating results this year, along with concerns around Taiwan's political situation. However, that is all reflected in UMC's relatively low stock price and generous 7.3 dividend yield. Number 5. National Storage Affiliates Trust (NSA). National Storage Affiliates is a fast-growing real estate investment trust, or REIT, focused on the self-storage market. Founded a decade ago, it is one of the newest large self-storage REITs out there. Just since 2018, it has grown annual revenues from $329 to more than $800 million. It has rewarded investors with strong dividend growth as the business has prospered. But 2023 was less kind to National Storage. Higher interest rates make it more expensive to build or acquire new storage units, along with rising interest costs when refinancing existing debt. Additionally, investors demand higher dividend yields from their REITs when the rates available on fixed income products increase. Now that yields have backed off their recent highs, however, the outlook for storage REITs such as National Storage Affiliates should be better. Shares currently yield 5.9. So if you liked the video, make sure to subscribe to our channel. And don't forget to press the bell icon so that you never miss our upcoming videos.